Timing is everything when it comes to retirement investing, but most people do it wrong. And I'm going to show you how we do it successfully for our retired clients. Now, you've probably learned that it's not about timing the market, it's about time in the market. So the best thing to do is just buy some investments and forget about it, right? But there is a research-backed strategy that uses just 2 rules and has historically helped investors avoid big losses and participate when the market goes up, and most investors are missing it. Many folks that first start working with us think they should use a mixture of about 60% stocks and 40% bonds in their retirement portfolio. This is the classic 60-40, but even the beloved buy and hold strategy can have its flaws. All investment strategies don't work perfectly 100% of the time. And we don't have to look too far back to see this example. As you'll see in this sample, a 60-40 portfolio, which consists of 40% US stocks, 20% international stocks, and 40% 7 to 10 year treasury bonds, was down about 16% in 2022. But it wasn't just stocks that were down. Bonds were also down double digits. And by most standards, that's a pretty big drop for a moderate investment strategy. And if you're taking income from your portfolio, that can make matters even worse. But of course, everyone wants high returns with low risk, except those type of investments don't exist. Investments that can earn high returns like the S&P 500 come with a lot of risk, where 20% losses are not uncommon and 30 to 40% losses are possible. What this means is the only way to earn high returns and limit your risk is to implement a timing strategy to decide when to sell high returning assets before they dive off a cliff. Of course, the problem with perfectly timing the market is it's difficult, dare I say, absolutely impossible. But there is a solution. When I'm talking about strategies to time the market, I'm not talking about gut feelings. It's not, your crazy relative at a family gathering who tells you they have a hunch the market is going to crash, so they moved everything to cash. In fact, trying to time the market based on emotions or a hunch is a recipe for disaster. But the academic research has shown that a concept called trend following has rules which have historically allowed you to participate in market upswings while avoiding large drawdowns. Now, it won't eliminate the short-term swings in the market day to day, but they have protected retirement portfolios from the most extreme loss situations. And the beautiful thing about the strategy I'm about to show you is that it's incredibly simple, it's easy to follow, and can be implemented using low-cost index funds. Again, there are 2 rules this data-backed strategy uses. Now, I'm going to explain these 2 rules, which are critical to understand, before I show you the performance of the trend following strategy. Of course, it's important to remember what I'm about to show you is not investment advice and should not be considered an investment recommendation. Now, the first rule is called absolute performance, and in plain English, it means comparing an asset class against the performance of a different asset class. And so when an asset class performance is worse than, let's just say, cash, you then go to cash. For example, we can see that in 2008, the relative performance of US stocks, the blue line, was worse than the performance of cash, the green line. So you'd move to cash. However, in 2009, we can see that the relative performance of US stocks, again, the blue line, was better than the performance of cash, again, the green line, so you'd get back in the S&P 500. All right, now the second rule is called trending performance, and in plain English, it means comparing an asset class to itself. And you usually do that by using what's called a moving average. When an asset class has a downward trending trajectory, you go to cash. For example, we can see that in 2008, the US stock market was trending downward, the blue line, and it was well below the orange trend line, therefore you go to cash. Alternatively, in 2009, US stocks were in an upward trend, the blue line above the orange trend line, therefore you'd get back in the US stock market. Of course, this seems simple enough, and I just cherry-picked one of the worst periods in investing history. So you might be saying to yourself, well, of course it would have worked to move to cash during the great financial crisis. And then secondly, the S&P 500 is just one of many asset classes. Many investors hold some bonds, real estate, and international investments as well. So does a trend following strategy like this work for other asset classes, not just in bad markets like the great financial crisis, but in good markets as well? So let's look at what the long-term data says. Now, this data is provided via Alpha Architect's blog post, which I will link in the description down below. They tested the rules we've just discussed from 1976 to 2014 on the following asset classes. So SPX is the S&P 500, EAFE is international stocks, LTR is the 10-year US Treasury bond, REIT is real estate, and GSCI is commodities, things like oil, gas, precious metals, etc. So first, let's see how each of these asset classes have performed with a simple buy and hold approach. Now, there are a lot of statistical data points on this chart, but I'm going to show you a few important ones. As you'll see, the S&P 500 has a compound annual growth rate of 11.74%. 10-year treasuries about 8.5%, international stocks about 9.6%, commodities about 5.5%, and real estate just a hair over 14%. And those returns look pretty good, but let's take a look at those drawdowns. In other words, how much those investments had declined in value at some point from 1974 to 2014. So for example, US stocks have seen a near 50% decline in value at one point in this period of time. And that means if you had $500,000 in US stocks, at one point, that balance was cut in half by $250,000. For retirees taking income in retirement, that can be a very challenging environment to keep your income going. So now that we have a baseline, let's see how the trend following strategy performed and compare it to the buy and hold strategy. Now, again, as a reminder, these are the trend following rules: relative performance and trending performance. And the rules were only looked at once a month. So if you're investing in US stocks, half your investment will follow the absolute performance rule, and then the other half will follow the trending performance rule. And again, you only look at these once a month, so it's pretty straightforward. First, let's look at the trend following rules applied to the S&P 500. The trend rules data is on the left, and the buy and hold data we just looked at before is on the right. And as you'll see, the trend following compound annual return is 11.71% compared to 11.74% for the buy and hold. But take a look at that drawdown piece because it was cut in half over that period. In other words, you achieved roughly the same annualized returns, but you had half the drawdown risk. And now let's look at 7 to 10-year US Treasuries. In this instance, we actually see slightly greater performance from the trend following strategy and significantly lower drawdown risk. Now let's look at international stocks. And once again, a very similar story with slight outperformance with trend following and significantly lower drawdown risk. Moving on to commodities, the results are even more astounding. Commodities are typically not the best investment to buy and hold, but we can see a massive outperformance in commodities with a trend following strategy, which did especially well during inflationary environments like 2022. And then lastly, we have real estate. Annualized compound returns are similar, but once again, the drawdown risk is significantly reduced. Now, again, the best part is this strategy can be implemented using low-cost ETFs. It's what we do for our clients. You don't have to buy expensive investment products or black box strategies. So let me know, were these the results you were expecting? Drop a comment below, and while you're at it, please consider dropping a like and subscribing to the channel. It is completely free and it helps us reach more retirees like you. Now, even though this is a strategy we use with our own clients in retirement, and although the data seems to be conclusive that trend following rules like this appear to work, over long periods of time by, again, keeping up with performance and drastically reducing major drawdowns during big market crashes, I actually don't think everyone should use a strategy like this. And the first thing is, using a strategy like this in a brokerage account is not ideal because of the potential taxation involved. Because a trend following strategy may trade often, using a brokerage account could result in significant realized gains eating into your after-tax returns. So if you have the choice, this is a strategy that really should be used within retirement accounts. Secondly, what's not shown in the data is tremendous tracking error from traditional benchmarks. In other words, a strategy like this will not look or act like the stock or bond market. A strategy like this can go years or a decade while underperforming traditional benchmarks. And let's be honest, for most investors, a year can feel like a lifetime, let alone 5 or just 10 years. And it's often during that period of underperformance that investors lose faith and then they abandon the strategy. But then when markets get crazy again and we experience another 30 to 40% crash, the strategy looks great again, and then people consider it once again. That's why we are always reminding our clients, A, how their money is invested, and B, we don't expect them to become financial experts. That's why they've hired us. But we have a heavy emphasis on education, because when you know why you're invested a certain way, that often leads to a better investing experience and greater confidence. Additionally, if you use a strategy like this, you should consider allocating an appropriate portion to your portfolio. For most folks, it probably doesn't make sense to allocate your entire portfolio to trend following rules, but perhaps it can make sense to allocate a portion like 10%. Your other 90% can still be buy and hold, but 10% follows trend rules, which will perform differently than buy and hold and may provide some protection in the future during large market declines. At least that's what's been the case historically. And that's why when folks come to see us, we sit down with every person to determine the right mixture of strategy for their specific retirement income needs. You know, this stuff can't be cookie cutter because your retirement is completely unique to you, and the right strategy can help you accomplish your goals. But maybe you've reached this part of the video and you're thinking to yourself, well, you know what? This all sounds great, but it is still way too complicated. My simple, low-cost investments in things like the S&P 500, which I like, have performed just fine. But there is a secret truth most people don't talk about. And in this video, I'll show you the data of why investing in only the S&P 500 is secretly putting your retirement income in danger and what you can do about it. I'll see you over in that video right now. Once again, this is Alex Okagawa, partner and financial advisor here at 1 Degree Advisors. And if you're interested in learning how we help our clients gain confidence in their retirement, visit our website at onedegreeadvisors.com.